Okay, let's jump right in. We're looking at VNET Group today.
Right, the big Chinese data center player. Carrier neutral, cloud neutral.
Exactly. And we're going to unpack their latest results, Q2 2025 earnings, forward guidance, really cut through to what matters.
Yeah, get you the core insights on their performance and, where they're heading. It's a good window into China's whole digital infrastructure scene.
Absolutely.
Yeah.
Because they're right in the middle of it. So Q2 financials ended June 30th. Pretty impressive story, right? Growth, healthy margins.
Definitely. Total net revenues, what was it? RMB 2,434 million.
Which is up 22.1% year over year and 8.4% just from Q1.
Solid growth. And the engine behind that, it's clearly the IDC business, internet data centers.
No question. But drilling down a bit, the wholesale IDC revenue, that's where the explosion happened.
Yeah. RMB 854 million, that's up like 112.5% year over year. I mean, that's staggering growth.
It really is. That's clearly the main growth driver right now. Huge demand signal there.
Massive. Meanwhile, retail IDC, it held steady mostly.
Pretty much. RMB 959 million, just a tiny dip from last year. Stable.
And the non-IDC side, the consulting, intelligent driving stuff.
Also stable. RMB 621 million. So they're diversifying a bit, but wholesale is definitely the headline act.
It shows that balance, right?
Yeah.
Aggressive growth where the demand is strongest, but keeping the base solid. Okay, so what about profitability? Adjusted EBITDA.
Right, the non-GAAP number. That climbed too, 27.7% year over year, hit RMB 732 million.
And the margin improved.
Yep, adjusted EBITDA conjure up to 30.1%. That's up 1.3 points from last year. Shows better efficiency.
And why do we focus on that adjusted number so much? Again, it's worth reminding folks.
Good point. You take out things like depreciation, amortization, maybe some one-off items.
Exactly. Stuff that isn't part of the day-to-day running costs. It gives you a much cleaner look at the core operational profit engine, especially crucial for capital-heavy businesses like this.
Makes sense. And their adjusted cash gross profit, another non-GAAP one that really surged, up 34.9% year over year. RMB 1,062 million. And the margin there, 43.6%. That's up significantly from 39.5% last year. Really healthy.
Wow. Okay, so the core operations are throwing off good cash profit. But there was that nuance with the net income, wasn't there?
Ah, right. They reported net income of RMB 17 million.
But the net loss attributable to VNET Group itself was actually RMB 11.9 million.
So why the difference?
It comes down to increased interest expenses, from borrowing for expansion and income taxes. So while operations are profitable, these other costs hit the final bottom line for shareholders. It's an important distinction.
Crucial detail. Okay, so they're expanding aggressively, profits look good operationally. How are they funding all this? Liquidity.
Seems pretty solid. They ended Q2 with RMB 4.66 billion in cash equivalents, restricted cash, short-term investments, a strong cushion.
And cash flow from operations.
Healthy. RMB 366.6 million generated in Q2. So the business itself is bringing in cash.
What about debt levels? Always a concern with big build-outs.
The metrics look manageable. Net debt to trailing 12 months adjusted EBITDA is 5.3x. Total debt is 6.4x. Generally seen as okay in this industry.
And when is it due?
That's key. It's well laddered. About 44% matures between 2025 and 2027. So no huge debt cliff looming immediately. Gives them breathing room.
Right. And fueling the growth, CapEx, big numbers there.
Huge. RMB 3.89 billion in the first half of 2025 alone. Mostly for that wholesale IDC expansion, as you'd expect. Serious investment.
Okay, so those are the numbers, but how do they achieve them? Let's get into the operations driving this, that wholesale IDC business again.
Yeah, the capacity growth there is just massive. They added 101 megawatts in service in Q2 alone.
Wow, bringing the total to 674 MW. And utilized capacity jumped too, by 74 MW to 511 MW.
And the overall utilization rate, still pretty stable at around 75.9%.
But isn't there a difference between the new stuff and the established centers?
Absolutely. If you look at their mature wholesale capacity, utilization is incredibly high, 94.6%, basically full.
Shows strong demand for their existing proven sites.
Totally. The newer ramp-up capacity is at 20.8% utilization, which is, pretty normal. It takes time to fill these massive new facilities.
How long does that usually take? What are the hurdles?
Good question. It can easily take 12, maybe 24 months, sometimes more for a really big deployment. The hurdles, it's complex. Moving huge IT systems, network setups, testing, it takes time.
So the fact VNET's mature sites are full while they're adding so much new capacity suggests they're managing that onboarding process well.
Seems like it. Strong client relationships probably help too. And speaking of clients, they had some good wins in Q2.
Right. On the retail side, about 4 MW in new orders. Diverse industries too. IT, internet, AIoT.
AIoT, artificial intelligence of things. Interesting mix. Financial services too.
But the big one, the real headline grabber.
That 20 MW wholesale order. Yeah.
From a top cloud provider through their Hebe joint venture, that's a massive vote of confidence.
Huge sign of that hyperscale demand, especially cloud and AI. Now, the retail side, you said it dipped slightly quarter on quarter.
Yeah, just a bit. Management said it was within the reasonable range. They expect it to be stable or maybe tick up going forward.
So it's the steady foundation, still important. Capacity there is over 52,000 cabinets, utilization edged up to 63.9%.
And the revenue per cabinet, the MRR, actually climbed to RMB 8,915, so still a solid base.
Definitely. Allows them to make those big wholesale bets. And they're certainly planning for the future. What's under construction now?
A lot. 326 MW currently being built. And get this, over half, 55.2%, is already pre-committed by customers.
That's strong. Reduces the risk significantly.
And beyond that, they have a huge pipeline. 374 MW for near-term development, another 418 MW for the longer term. It's like a land bank for data centers.
So the delivery plan for the next year?
Ambitious is an understatement. They plan to deliver that 326 MW under construction over the next 12 months. 227 MW just in the second half of this year, 99 MW in 2026.
Wait, 326 MW in 12 months? That nearly triples what they delivered in all of 2024.
And more than the last 3 years combined.
Okay, so this isn't just growth, it's a massive acceleration. They are betting big on demand staying sky high, especially for AI.
Which leads us right into their grand vision, Hyperscale 2.0. They unveiled it at their investor day.
Right. The goal is, what was it, 10 gigawatts?
10 gigawatts of assets under management by 2036. Just think about that scale.
10 gigawatts. I mean, what does that even mean in practical terms? What kind of build-out are we talking about?
It's audacious. Achieving that would make them absolutely fundamental to China's AI infrastructure.
Yeah.
We're talking vast amounts of land, huge power contracts. It's like building digital cities.
And it's explicitly driven by AI, right? Shifting from traditional IDCs to these ADCs, artificial intelligence data centers.
Exactly. It's a whole strategic shift from just delivering projects to providing complete ADC solutions.
And how are they planning to build so fast? Any tech innovations?
Yeah, they talked about building standardization, using standard modules, kind of like Lego blocks for data centers.
That's down construction time.
By a third, they claim. Faster, more predictable, scalable, crucial for meeting urgent AI demand.
And modular data centers, too.
Right. Pre-built, pre-tested modules for power, cooling, everything. Factory-made. Makes installation way faster.
And easier to upgrade later, presumably. Swap out a cooling module for a newer, more efficient one.
Exactly. Extends the life, reduces costs. Smart stuff, really geared towards the speed and power needs of AI.
Plus, the big regional hubs they're planning, Inner Mongolia, Hebei, Beijing, from single cabinets up to gigawatt-scale campuses.
It's a comprehensive strategy. And management was very clear. The demand for AI remains unchanged. Orders are mostly AI-driven.
That's the conviction you need when you're planning investments on this scale. Confidence in the core market driver.
So with all that ambition and the strong Q2, what's the guidance for the rest of 2025? They raised it, right?
They did, which is always a good sign. Total net revenues now expected between RMB 9,150 and 9,350 million.
That's 11% to 13% growth year over year. Pretty healthy.
And adjusted EBITDA guidance also up. Now RMB 2,760 to 2,820 million. That's 14% to 16% growth.
But didn't you mention if you exclude a one-off gain from last year?
Yeah, good point. If you take out an RMB 87.7 million disposal gain from 2024 figures, the underlying growth guidance is actually more like 18% to 20%, even stronger operationally.
And importantly, CapEx plans remain unchanged.
Unchanged. Still guiding RMB 10 to 12 billion for the year, and the delivery plan 400 to 450 mil W for 2025 also unchanged. Shows commitment to the build-out.
And signaling confidence to shareholders, too, with that share buyback.
Right. Up to US $50 million over the next year. Management clearly thinks the shares are undervalued given the growth prospects.
Now, management's commentary. They sounded a bit cautious about the second half, despite raising guidance.
A little. They called the outlook relatively conservative. Said they needed to watch and see if utilization speed is affected by, quote, the the chips. Chip supply is always the elephant in the room for AI.
But they seemed confident they could upgrade again if things go well.
Yeah, they did say if wholesale utilization keeps up its pace, they could raise guidance further. So cautious optimism, maybe.
And on those chips specifically, any impact on current orders?
They said they checked with core clients and confirmed that orders at hand will not be affected by supply constraints. That's a significant reassurance.
Good to hear. They also mentioned a one-off income boosting wholesale MRR in Q2.
Yeah, from higher electricity bill revenues. Important for you, the listener, to know that's not recurring core service revenue, just a temporary bump in Q2.
Got it. And GAAP margins fluctuating. That's down to accounting timing.
Pretty much. When they move assets from construction in progress to property, plant, and equipment on the books, depreciation kicks in differently. So GAAP figures can bounce around a bit due to timing. Again, why adjusted figures give a clearer operational view.
Makes sense. And they're also looking at REITs, real estate investment trusts.
Actively promoting them. Yeah. Public and private. They're targeting recovering RMB 2 billion in 2025 through these, basically selling stakes in some assets to recycle capital into new developments.
Smart way to fund growth.
Yeah.
And that winter power project, wind power.
Yeah, that's underway. Expected to start delivering power late 2025 or early 2026. Initially, more of an investor relations boost, showing their green credentials, than a P&L impact.
Which is a perfect link to their whole sustainability effort. That's becoming huge for data centers, isn't it?
Yeah.
Given the power they consume.
Absolutely critical. And VNET seems serious, targeting operational carbon neutrality scope 1 and 2 and 100% renewable energy use by 2030.
That is a very ambitious target.
It is. And they're getting recognized for their efforts. That A rating from MSCI for the 3rd year running.
Highest in their sector in China. And the S&P Global Sustainability Yearbook inclusion, top 7% globally in IT services.
Plus, good ratings from CDP on climate change and supplier engagement, and that PUE number.
Right. Power usage effectiveness. 1.27 for their stable data centers in 2024. What does that actually mean? Is 1.27 good?
It's actually really good. A perfect score would be 1.0 all power going just to the computers. So 1.27 means they're very efficient, wasting very little energy on things like cooling overhead. That saves money and carbon.
So ESG isn't just about looking good. It's about efficiency, cost savings, attracting investors, attracting clients who want green solutions.
Exactly. Especially for power-hungry AI data centers, it's becoming table stakes.
So to wrap it up then, VNET Group. Strong dual-core strategy, riding that AI wave with explosive wholesale growth, solid retail base.
Powered by that Hyperscale 2.0 vision, betting big on AI demand and building greener, smarter data centers for the future.
It's a compelling story, but it leaves you thinking, doesn't it?
Definitely. VNET is clearly all in on AI infrastructure. But this race for computing power, the push for cleaner data centers, it's intense, it's global, and it's really just getting started. What's it really going to take for them and the whole industry to not just scale up, but to truly build and redefine the digital backbone will all rely on tomorrow.